I think if you look at the ECB decision yesterday, that it was broadly in line with expectations, no big surprises there, and you hardly had any market reaction yesterday and also today. So it was, if you look at year to date, also what's been driving the European market, it was mainly driven by other jurisdictions, for example, the US. So I think on the back of the ECB yesterday, there was no surprise, and I don't think there was a lot of market reaction on the back of this.
Also, no pre-commitment to any future cuts in interest rates then. Was there enough room left for the data dependence conversation that keeps on being emphasized a little bit more than usual?
Yeah, I think so. They haven't changed the script. They stick to data dependence, not data point dependence. Lagarde cited that in September they've basically been guiding towards December, and then 2 weeks later they've been guiding towards October as a case for data dependence. But I think overall, yes, there was no pre-commitment for December either, so they could cut, they could decide not to cut. Our baseline is for 25 basis points. And overall, if you look at what the market is pricing with kind of back-to-back cuts back towards a more neutral policy rate for the euro area, this seems broadly reasonable. So while the precise path is interesting, I think more relevant or important is the terminal point of the cutting cycle.
Yeah, what do you think that terminal point then is?
That's a very interesting question for the euro area. We have a little bit more like visibility when it comes to the US or the UK, but for Europe, indeed, the verdict is out. We had a very low policy rates before the pandemic, and it was only the pandemic and the war that allowed the ECB to actually raise interest rates. We have been talking about Japanification. So there were a lot of structural forces at play in the euro that kept policy rates low, and they probably haven't all miraculously disappeared. So the verdict is out. We think 175 or between 175 and 2, what's currently priced, seems reasonable, but we wouldn't be surprised if it's actually a bit lower than that.
Markets are betting the same thing, though, stateside, aren't they? It's almost similar then. Is that fair to put forward, though, that Europe is going to cut as much as the US? Because surely both would be cutting for different reasons, which means that the US would be cutting a little bit slower than even in Europe.
Yes, so there was a lot of discussion how the cutting cycle will look like, as the hiking cycle has been fairly synchronized. I think overall, I can come up with good arguments for the ECB to be faster than the Fed, but I can also see arguments for them to be slower. If you look at wage growth across jurisdictions, if you look at wage demands coming out of Germany, if you look at the productivity differential between the jurisdictions, that could suggest, while growth is weaker in Europe, that the ECB potentially has a harder last mile than the Fed. So I think I wouldn't get overexcited and on the relative pace. I think it will be fairly synchronized at this point in time.